Securize sat down and had this really in-depth talk about what they're building with the New York Stock Exchange. They're creating a full platform for tokenized securities. They also got into where all of this is heading in the future. Think about it. Pretty much every big player is getting into tokenization now. The DTCC, NASDAQ, and the New York Stock Exchange are all making serious moves. The reason this matters is simple. These big institutions are eventually going to need public blockchains to bring in the kind of liquidity this whole thing needs. On another note, Bloomberg analyst James Seyffart pointed out something a lot of people are missing. He says most folks in traditional finance still think digital assets are a joke. They don't take any of it seriously, and that's probably going to hurt them later. Then there's Raoul Powell sharing his thoughts on the 4-year cycle. He basically says that pattern is pretty much over. He believes 2026 is going to be a much stronger year for the market. Here's something else that stood out. SoFi, a company with about $40 billion in assets, just launched a brand new banking platform built specifically for businesses that want to work with Bitcoin and crypto. That's a huge step, and I have several more stories to share after this. First, Cathie Wood has been talking lately about where she thinks Bitcoin's price is going. Then, on a different note, the executive chairman of Hive Digital Tech threw out a bold target of $250,000 for Bitcoin. And here's the key point. If Bitcoin gets anywhere close to that number, coins like Ethereum and XRP won't stay flat either. The whole market would likely rise with it. All right, let's start with this first part. Take a listen. I'm glad you brought up the NASDAQ proposal because, like you said, the SEC approved it a couple of weeks ago. This would let certain stocks and ETFs trade in tokenized form. We don't need to get into all the small details, but how does what NASDAQ is doing compare to what the NYSE is working on with tokenization? Are they pretty similar? Yeah, I think they're coming at it from slightly different angles. The NASDAQ proposal would allow trading of tokenized securities, and it lets them settle either in token form or the traditional way through the DTCC. They also announced partnerships with Kraken and some other companies. Meanwhile, the NYSE said they're setting up a new alternative trading platform where people can trade tokenized securities. On their platform, they'll have different kinds of tokens that aren't just from the DTCC. As we mentioned before, Securize is going to act as the digital transfer agent for the NYSE platform. So the tokens we create outside of the DTCC will also be tradable on the NYSE's new platform. What really catches my attention is how all these systems are connecting with each other. That kind of interconnectedness shows that real infrastructure is being built behind the scenes. People like Paul Atkins and other analysts who follow this space have started giving timelines for when traditional securities will actually move on-chain. The general agreement keeps landing somewhere between 12 and 24 months from now. The DTCC even narrowed it down to a 52-week target. But the story that really shows where things are going comes from BlackRock. Their team confirmed plans to tokenize their entire iShares ETF lineup. Just in the US, that portfolio is worth around $3.5 trillion. If you include the global side, it's over $5 trillion. They're working on a timeline of 3 to 12 months for this. That means things are already in motion right now. When you think about the world's biggest asset manager going all in on tokenization like this, it changes everything. No other big firm in the industry can afford to just sit back and watch. They're either already working on it quietly or rushing to catch up. We just haven't seen those announcements yet, but I'd bet the next 3 to 6 months will be full of news from companies we haven't heard much from until now. Now here's what James Seyffart had to say. Listen to this. I work in the research department at Bloomberg Intelligence. I've been seriously covering this space since 2017. I've believed in Bitcoin and crypto long before most people did. For most of my professional career, a lot of people at Bloomberg have basically laughed at me or rolled their eyes. There are still plenty of folks there who think the whole thing is a complete joke. A lot of younger people don't really get it. To be fair, crypto has had a ton of scams and fraud. There have been lessons that traditional markets learned 50 years ago about things like deleveraging, so those issues are real. Some people just never believed in it and still don't. Even when serious developments happen, they're not willing to change their minds. There are some who are starting to adjust their views. We actually just hired someone new to cover crypto markets directly in Bloomberg Intelligence, so it's being taken a bit more seriously now. But at the higher levels, it still feels like they're only doing it because they have to. They're dipping their toes in, paying attention, but there's no big push to lead in the space. When I go to traditional finance conferences, it's the same thing. A few of us believe in what's happening, but most people either don't care or are openly against it. All these major financial players have access to the same data, and the numbers paint a clear picture. Younger people really want crypto. If you put a traditional product next to a digital asset and show it to them, they're choosing the crypto option almost every single time. That puts the old school firms in a tough position. Right now, their main customers are people from my parents' generation who grew up with regular stock portfolios and mutual funds. But when you look at millennials and the generation after them, their interests are totally different. Crypto and blockchain are what get them excited. These big institutions have to figure out how to meet the next wave of money where it's flowing. According to a Forbes report, more than $70 trillion in wealth is going to change hands over the next 20 years as it passes from one generation to the next. All that money will end up with younger people, and they're going to put it where it feels natural to them. That's one of the main reasons Wall Street and blockchain are coming together right now, but following what younger investors want is only part of the story. The technology itself fixes real problems that have bothered finance for decades. Transfers settle in seconds instead of days. Transaction costs drop dramatically. Every trade has a permanent visible record that regulators can check anytime. Once it's on the record, you can't go back and change it or erase anything. That alone cuts down on fraud a lot, and that's just the beginning. The benefits keep adding up. This isn't just adding a couple of cool features to an old system. When that huge generational wealth transfer happens, the people getting the money will steer it toward what they're used to and what actually makes sense to them. That fact alone is pushing traditional finance straight toward blockchain. But there's even more to it than just chasing the next generation. The speed changes everything. Money gets where it needs to go almost instantly. Fees become a tiny fraction of what they used to be. And for regulators, they get a completely clear view of every trade, who made it, when, and for how much. No one can sneak in later and mess with the records. Fraud takes a big hit when there's no way to hide or change the data. I could go on because the list of improvements is really long. Calling this just a small update to how finance works misses the whole point. Now let's talk about the cycle. People used to say there was some kind of rule from Satoshi that there had to be a 4-year cycle, but Raoul Pal thinks that pattern has basically run its course. He explained that all these cycles, the ISM, the NASDAQ year-on-year changes, were driven by the same debt cycle that started back in 2008. They reset interest rates to zero and put most debt into short-term buckets of 3 to 5 years, so every 4 years they had to roll over that debt. He started wondering why the business cycle wasn't picking up like he expected. After digging into the everything code, he found that in 2021 and 2022, they actually extended the debt duration because rates dropped again. They pushed the average maturity out to just over 5 years. That means the big year, when they normally need the most printing and debt refinancing, has shifted from year 4 to year 5, so now he's looking at 2026. That's when liquidity will really be needed because there's about $10 trillion in debt that has to roll over. We're talking about a massive amount of money moving through the system. And of course, nobody can ignore the chaos happening in the Middle East right now. Everyone wants to know how it ends and what the situation will look like afterward. Getting back to anything close to normal isn't going to be quick. Important oil and natural gas infrastructure has taken serious damage, and fixing some of it could take years. The tough reality is that the world is probably going to face rough times for at least 6 to 12 months while everyone figures out the next steps. Hopefully things calm down and rebuilding can start. This next story is one of the reasons I wanted to bring this up. Sophie, sitting on $40 billion, just launched their new business and crypto platform. In the last few days, both Franklin Templeton and Sophie made big moves. You can see a clear pattern forming. The big traditional finance firms are out shopping. What they're buying is crypto infrastructure, the systems and tools that will let them offer digital asset products straight to their customers. The number of solid companies that actually build this stuff isn't endless. Once they're bought, they're off the market. That scarcity is creating a real rush right now. Firms are making deals and grabbing whatever blockchain infrastructure they can find. It's basically a land grab. Everyone wants to be fully prepared for what's coming. Listen to this part from SoFi. It's great to see you in person. Good to see you too. So what's happening here? This is a big deal. Yeah, it really is a big day and a major milestone. It kind of reverses how things have been. We've always wanted to be a one-stop shop for all your financial needs. One thing we've been missing for the last 2 years was the ability to let customers buy, sell, and hold cryptocurrency. We couldn't do that as a bank. It wasn't allowed. But in March this year, the OCC came out with an interpretive letter saying it's now okay for banks like SoFi to offer crypto. So this morning we're launching as the first and only national bank that gives customers the chance to buy, sell, and hold cryptocurrencies like Bitcoin. Now check this out. Bloomberg analysts said on TV that Iran's military is actively using Bitcoin and crypto to buy weapons and oil. That one surprised me. Listen to what they said. We saw heightened activity on crypto exchanges in Iran after the events. People need to know that about half of this activity comes from regular Iranian citizens trying to get away from the regime. The other roughly half appears tied to the IRGC using it to buy weapons and handle oil trades, like taxing ships through the Strait of Hormuz. That pretty much speaks for itself. Of course, you also have Kathy Wood sharing her thoughts on Bitcoin. She said we're seeing the institutionalization of this new asset class that doesn't move in step with other investments. In the Bitcoin community, even a 50% drop would be seen as not too bad, because this is now a proven technology and a real new asset class. Then Frank Holmes, the executive chairman of Hive Digital Tech, said that if stablecoins start offering rewards, it could make the whole crypto ecosystem explode and push Bitcoin up to $250,000. He explained that paying interest or rewards on stablecoins would be huge, but banks are trying to stop it because they don't want to lose depositors. He compared it to his experience with mutual funds and ETFs. Right now, traditional bank accounts give you almost no interest, and they might even charge fees if your balance is too low. So when platforms like Coinbase offer yields of 3 to 12% in Bitcoin for holding USDC, it feels threatening to banks. But he sees that as healthy competition in a free market. Once that kind of thing really takes off, he thinks Bitcoin could hit $250,000. After that, he went into a story about money markets from 30 years ago. But the part that really matters is what he said about AI agents. An AI agent can't just walk into Chase or Wells Fargo and open a checking account with paperwork. That option doesn't exist for them. So crypto wallets become their natural financial tool. Bitcoin might play a role on the edges, but stablecoins will probably do most of the everyday work. Coins like XRP, Solana, and Ethereum could all be part of how these AI agents move money. When you look at the big picture, we're looking at trillions of transactions over the next 10 to 20 years, and almost all of them will need blockchain infrastructure. The numbers make it impossible for old systems to keep up. A 30-cent payment through traditional pipes might cost you 30 cents in fees. That just doesn't make sense anymore. The amount of activity happening across the whole space right now is massive, and seeing all these pieces come together has me really excited. I also wanted to touch on the coverage about Iran, the situation there, and worries about a recession. Lynn Alden explained on CNBC why this period feels different from anything we've seen between 1980 and 2020. She said that in the last 7 or 8 years, the US and some other countries have moved into what's called fiscal dominance. That means high public debt and big fiscal deficits have changed how much power monetary policy really has. Monetary policy isn't as effective at controlling inflation as it used to be. With deficits this large, the economy tends to run hot. We see higher nominal GDP growth, and asset prices in dollar terms stay stronger than many people expect. Even so, stocks have underperformed gold over several years. Unfortunately, these kinds of issues tend to happen in clusters. Higher public debt often leads to more populism and unexpected geopolitical problems. She also thinks we're heading into a more multipolar world. All of these forces are creating market conditions that are very different from the relatively calm 40-year period we had from 1980 to 2020. Nobody can say for sure which way the markets are going to move, and that uncertainty isn't going away soon. Not until there's a real pause and a clear look at what's happening in the Middle East. I'll keep following all of this and bring you more updates as things develop.